Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome to episode 339 of the Independent Advisors Podcast. On today's show, we're covering a few timely and important topics, including annual inflation numbers, an update on earnings season, today's investment opportunity environment, and ramifications on capping credit card interest rates at 10%. Whether you're tuning in for market insights, planning tips, or just staying informed, there is something here for you. So today's show will be slightly different, as it's going to be a solo show with yours truly, as Matt is out for today. So it might be a little bit of a quicker episode, but nonetheless wanted to still throw out something for somebody to listen to this week to give an update on markets and some important financial planning topics.
Before we get into this week's show, listeners, if you've been enjoying the Independent Advisors Podcast, I'd encourage you to head to our website, jessupwealthmanagement.com. I offer a 15-minute initial call where you can discuss your financial goals and see if JWM is a good fit for your needs. Scheduling is easy. Once you land at the jessupwealthmanagement.com website, just click Schedule Initial Call and select a time that works best for you. There's a quick survey to fill out that will help guide the conversation and ensure your time is used efficiently. If you're ready to learn more, visit jessupwealthmanagement.com and book your call today.
So as always, we will review the month-to-date and year-to-date performance numbers of the major indices that we track. This data is from Y-Charts and as of the close on February 18th. S&P 500 index down 0.8% for the month and up 0.5% for the year. The Dow Jones Industrial Average is up 1.6% for the month and up 3.3% for the year. The NASDAQ Composite Index down 3% for the month and down 2.1% for the year. The Russell 2000 Small Cap Index up 1.7% for the month and up 7.2% for the year. And the Vanguard All World X United States Index Fund is up 3.7% for the month and 9.6% for the year. 3-month Treasury rate at 3.7%, the 2-year rate at 3.47%, and the 10-year rate at 4.09%. Moving into big headlines, current events from this past week. The latest inflation report was released Friday, February 13th, with the following data reported by the Wall Street Journal. So annual inflation slowed to 2.4% in January from a year earlier, below expectations of 2.7% due to declining gasoline and used vehicle prices. Cooler price increases overall obviously are positive news for the economy, easing concerns that the Trump administration's steep tariffs will lead to a broader ongoing inflation problem. And then lastly, core prices, which exclude volatile food and energy items, rose 2.5% from a year earlier, in line with expectations. So the Wall Street Journal had this graphic that Jenna will throw up here on the YouTube video. It'll also be in our show notes, but it just shows the change in prices from a year earlier for some select categories, including ground beef, watches, hospital care, funerals, apparel, used cars and trucks, gasoline, and some other ones if you want to check out what has been driving inflation or cooling it down. So moving right along to tweets, articles, and research from this week. The first thing I had was a post from Gunjan Banerjee, which I hope I pronounced that name right, on February 11th. So what she said was the average stock reporting so far this earnings season has moved 5.2% up or down, the biggest post-earnings move since at least 2012. So as Matt and I have talked about the past couple of weeks, we're on the tail end really right now of earnings season, but over the past several weeks, there's been some really important earnings reports from some of the largest companies in the world. And if it feels like stocks that you own are more volatile this earnings season, you're correct with this stat, right? Typically when you go through an earnings season, you will see volatility pick up a little bit. But again, as this person said, we haven't seen this type of volatility during earnings season since 2012, according to Citi. So if it feels like things have been moving up or down a little bit more than usual, that's because it has. Moving on to my second item, this is just a great quote from Peter Lynch, who is a former famous mutual fund manager. So he says, quote, "I'm not interested in why it's going up. I'm interested in the fact that it is," end quote. And, Peter Lynch might be one of the most famous mutual fund managers throughout history. And I really like this because I think too many times people get too infatuated with the story of a certain publicly traded company, right? Or you get attached to a certain name that, you say you're going to hold it for the rest of your life and you're never going to sell it. And I think that's where people maybe get misled in this industry, is that you need to fully understand every single fundamental within the company. You need to understand, what segments and operating departments are making the money and driving the revenue and earnings growth for the company, what new products they have coming out, what their new competitors are. And that's not necessarily the case. So I'm not advocating for someone to go out and buy a bunch of companies that don't make a lot of money. But if you think back to the few months after COVID in 2020, a lot of the names that did the best had no earnings and not a lot of revenue growth, right? So there are times where it's okay to be involved with some of those companies. So that's why here at Jessup Wealth Management, we put such an emphasis on price and technicals at times. Is we don't really care what it is or why it's going up, but just that it is going up, right? We want to own the strongest stocks within the strongest industries, within the strongest sectors. And I think, Peter describes that pretty simplistically here with this quote. Next thing I had was a post on X from Unusual Whales and TrendSpider on February 2nd. This one's kind of a funny one. The Unusual Whales account tweeted, "Gold could hit 6,000 this year per Deutsche Bank." And TrendSpider followed that up with, "Translation, buy the dip so we can unload the rest of our bags on you." And if you've been listening to this podcast or you are a client of ours, you will know by now that I am not a huge fan of price targets or analyst forecasts or estimates. And this is one of the reasons why. So you have Deutsche Bank coming out saying gold could hit $6,000 an ounce this year. And people read that and they're like, okay, well, I'm going to buy gold. If, Deutsche Bank thinks it's going to go to 6,000, I can make X percent from what it's trading at right now, right? And what people don't realize is sometimes these big banks or these big investment firms will say that so that people will buy up whatever security they're talking about. And so these companies can just unload the rest of their holding at a higher price than what it's trading at right now. So I'm not trying to be a conspiracy theorist or say that happens all the time, but you just need to be wary of that sometimes people are going to pump certain things so that it benefits them and their firm, right? So I think you just need to be aware of it. So it was kind of a funny interaction on X, but also something that we can learn from. So the final thing that I had in terms of research from this week is taking a look back at something that we brought up earlier in 2025 after the tariff sell-off in April. So this was a post on X from Ryan Dietrich on February 1st, and he said this: "Here's what we shared on April 4th, 2025 when the VIX moved above 50. Doesn't feel like it in the moment, but this is a great buying opportunity usually. We'll have another VIX 50 eventually, and no one will want to buy it when it happens. Just wait." So Jenna will throw this up on the YouTube page. It'll be in our show notes, but it's a chart of all of the spikes in the VIX above 50, going all the way back to 1990. And again, very quickly, the VIX is kind of the fear gauge in our industry. So when the VIX goes up, usually stocks are going down, volatility is increased, kind of a sign of bad things to come over the next couple of trading days or next couple of weeks. It's based on options pricing. Won't get into it today, but essentially all you need to know for this conversation is it's the fear gauge, right? And it has an inverse relationship with the S&P 500 or stocks for the most part. And again, back on, let's see what this was, April 4th, April 4th, the VIX spiked above 50 in 2025. And Ryan and several others, including us, were like, hey, long term, this is probably a pretty good buying opportunity, because if you look back at the past, when the VIX gets this high, usually the fear is overdone. And fast forward to today, that's exactly what happened. After the tariff sell-off in April, stocks recovered really nicely, got into the green, into double digits, in fact, if you're looking at the S&P 500 for 2025. So again, in that instance, it ended up being a great buying opportunity. I'm not saying that that's going to happen every single time in the future, but if you are a long-term investor that can handle some drawdowns and some volatility, typically that's one indicator that I like to look at to see if we're getting closer and closer to a bottom. We wanted to take a minute and tell you about a service we personally use and trust, LifeLock by Norton. With everything we do online these days, protecting your identity and personal information is more important than ever. That's why we've partnered with LifeLock, a leader in the identity theft protection industry. Their mission is to empower people to live their digital lives safely, offering tools to help protect you and your family from threats like identity theft, cybercrime, and fraud. They combine advanced technology with 24/7 support to keep your information safer in today's connected world. We use it ourselves, and we think it's a valuable tool for anyone looking to add an extra layer of protection. If you're interested in checking it out, you can use our special link to get a discounted rate. As a heads up, we do receive a percentage of compensation if you sign up using our link, but we partnered with LifeLock because we believe in what they offer. To learn more and get the deal, just head to jessupwealthmanagement.com/LifeLock. So that will wrap up the tweets, articles, research segment for this week. I want to finish this off with our financial planning topic of the week, which is talking about the ramifications of capping credit card interest rates at 10%. So taking politics completely out of this, this topic has been very prevalent in the news cycle over the past couple of weeks, and President Trump wants to cap credit card interest rates at 10%. And maybe you're sitting there and you're like, well, it sounds like a good thing, but I don't really know what the ramifications of this are. So we want to discuss some of the potential outcomes if this were to happen. So a little bit of education here. Lenders and banks use higher interest rates to price for risk. That is how banks loan money out, right? So when lenders no longer have the ability to price for risk with interest rates, their losses could rise, the availability of credit for consumers will decrease because banks don't want to take that additional risk, right? So in theory, this could hurt people who need to borrow money the most. So if banks are lending to someone they deem is very risky, it's 50-50 odds that this person's going to pay the money back, they're going to jack up the interest rates to account for that, right? So that just makes sense. In addition, this could have negative effect on stock prices and earnings of companies in the credit card and lending business. So just a simple example I tried to create to kind of break this down for people. If you imagine a bank is like a lemonade stand, but instead of selling lemonade, it lends money to people. Some people are very likely to pay the money back. Some people might not pay it back at all. Because of that, the bank charges higher interest rates, so it's worth it for them to lend to riskier people in the event that they don't pay the money back. And it's a win-win situation. Bank gets compensated for taking the risk, and the people that need to borrow the money have access to borrow the money. The extra interest rate helps the bank pay for people who don't pay the money back, combat fraud, and pay their employees. If the government comes in and says you're only allowed to charge 10% interest, no matter what, the bank can't charge more to risky borrowers, and it no longer makes financial sense for banks or lenders to be in that business. This could lead to fewer people getting credit cards, lenders losing money, and it would be more difficult to borrow money. In addition, credit card reward programs will likely go away or not be as valuable. So the info I'm about to share is from Amanda Orson. This was a post on X. This link will be in our show notes for those who want to go check this out in full. But just a few pieces from this. So Amanda says your credit card rewards exist because someone else is paying at 25% APR, annual percentage rate. Cap that at 10% and the points don't survive. I spent years working inside fintech and card programs. The interest margin is the invisible buffer that makes rewards, lounges, and credits possible. Capping credit card APRs at 10% sounds like an obvious consumer win. Cards charge 20 to 30%. Many consumers revolve balances, and the system feels punitive. So in conclusion, what I have, gotten from this is that there are several potential negative side effects of capping rates on credit cards that may not seem obvious from reading the initial headline. So I think it's just something that might need to be worked through a little bit more before just putting this into effect, because again, it's going to have a massive effect on institutions. But I think the other side of it, and the more important side of it, is that people who need to borrow money the most might not have access to do that in the future. So hopefully that helps. If you have any questions on that, please send it in. If you need clarifications, we'd love to talk about this more, because this is going to affect a lot of people if this changes. So that will do it for us this week. Thank you for tuning in and listening to episode 339 of the Independent Advisors podcast. We will be back with you next week for episode 340.
Thank you for listening to the Independent Advisors podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Facebook, Twitter, LinkedIn, and X. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.